Hi, folks. Adam Taggart, co-founder of Peak Prosperity, here back for another week of making sense for the markets with the lead partners from New Harbor Financial, the financial advisory firm endorsed by Peak Prosperity. And what a week this week is. Very different from the past several weeks we've been talking about because the markets took a massive drop today. So we got lots and lots to talk about. But first, let me introduce my cohorts here for the video. We've got Mike Preston. Hi, Mike.
Hello, Adam.
Good to see you again. And John Lodra. Hey, John.
Hey, Adam. Good to be back after missing last week's video.
We missed you. At least we had Wolf Richter as a stand-in, but they were big shoes for Wolf to fill.
We won't debate that.
All right. Well, look, let's get started on this week. As usual, a quick little context beforehand for folks that haven't maybe watched our past several weeks. But we've been spending a lot of time talking about how manic the markets have been and warning folks not to get caught up in the euphoria and the mania. So I want to put up a chart here of the S&P. John, you were reminding me there's many more sort of parabolic charts here of what's been going on in the markets. But what I wanted to show here with this one is this is the past month of the activity on the S&P. It's gone from 2,500 to almost 3,500. And if you look at the past 17 trading days before today, 13 of them were green, right? 13 of 17 up days. It's almost as if the system had just eliminated down days. And the down days that we had were quite minor ones. So it's a 31% increase in just a month. I mean, that's a ferocious increase on the overall market. So, we showed this chart last week here showing the NASDAQ, which had just hit record highs. It hit record highs again earlier this week, showing that V-shaped recovery here where the NASDAQ was now higher than it was back in February before it collapsed. Now, at the same time that the NASDAQ has had that a massive record recovery, the consensus for the 12-month forward earnings per share from the companies that make up the NASDAQ has dropped by like 30 or 40%, right? Just showing the disconnect that we've been emphasizing between what reality is on the ground in the economy versus the fairy tale story that the stock market is telling us. We also showed this chart, which is the PE of the Russell 2000. You can see it's at a historic high here. The reason why this one stands out in such stark contrast is because as we look at the tens of millions of people that are losing their jobs and the companies that are declaring bankruptcies, the Russell is made up of the smaller players. These are the weaker players on the board. These are the people, the companies that are at most risk of disappearing because they go bankrupt and have to shut down from coronavirus and the destruction that's wreaking on the economy. And yet these companies have been racing to record high levels of valuation. So we've been, waving these red flags the past month or two here on these videos. It's gotten so bad, looking at this next chart, that companies who declare bankruptcy are finding that that's a massive stimulant to their stock prices. This chart here is a little bit hard to read, but it basically tracks three different companies, two in the energy space, Chesapeake and Whiting Petroleum, but also Hertz. And I think many folks have probably heard in the headlines over the past couple of weeks that Hertz declared bankruptcy. Since it did, its stock's been up 300%. Chesapeake's up over 400%, right? Folks, these are sort of the classic signs of a mania where things that just don't make sense are acceptable. And so, folks that are speculating like this on companies that are entering into bankruptcy, very, very hard to come up with a cogent argument for why that makes sense. We've seen too that the retail investor is finally back into the market. And folks, you've heard that old expression, if you're sitting down at a poker table and you don't know who the sucker is, then it's likely you. Retail investors, particularly small retail investors, are very sort of famous as being the dumb money at the table. They're the ones that come in last. They buy at these high valuations because they don't have the investing expertise. They get caught up in all of the emotional mania, and they end up making very irrational investing decisions. And they tend to be the bag holders at the end when everything reverses. This chart here is showing the increase in accounts at Robinhood, which is a very popular online trading platform with millennials and now increasingly Gen Zs, which are quite young kids in their teens, who are now all of a sudden getting into investing. This very much has the same feel that the dot-com era did. back where, folks that had never traded a stock were all of a sudden, throwing lots of their life savings into companies that they had never heard of and had no clue what they did, but they were going up. And so that made sense. So we're seeing that happen here at the retail level. But we probably don't see greater examples of the exuberance and the irrationality going on than in these next two visuals. This is a chart here of from Google Trends showing the increase in searches on the terms day trading and call options. And you'll see here just a tremendous spike in the start of 2020. And that's really just happened over the past 2 months or so. So this is a classic bubble sign of inexperienced investors jumping in. And folks, if you don't know what a call option is, and you haven't, invested much in stocks, let alone options, you should not be buying call options. I mean, most of these people are just playing with fire here. That's an example of what the masses are doing. I want to play a quick clip here that I think captures much better than anything I could say about the type of mentality of folks that are drinking the current Kool-Aid that the market will never go down again.
Alaska Airlines up 17%, Boeing up 13%, Carnival up 16%, Delta up 7.5%. What do you do if you listen to old man Buffett? Get out of the airlines, idiot. What an idiot. Norwegian up 18%, Spirit up 12%. Unbelievable. All I do is make money. This game's so easy. Look at me. It's so easy. Literally the easiest game I've ever been a part of. Up, 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 up. It's just, I'm just printing money. I'm up 290 grand on the day, and I'm mad. And I'm mad as hell. Because I've sold so much of my airlines because you take profits, people. Why take profits when every stock goes up? Every airline goes up 20% every day. You just wake up 20%. Losers take profits. Winners push the chips to the middle and know the 7 ain't coming. I should be up $1 billion. I should be up $1 billion. That's how right I have been about cruises and airlines. They're not just up; they're up 1 billion%. I should be up $1 billion.
Okay, guys. I mean, that is crazy, John, Mike. I mean, does this remind you of previous bubbles that we've been through?
Yeah, absolutely. It's manic, mania. Get me in as quickly as you can, or really the hallmark is when this is easy starts being talked about. Where I can't believe not everybody's doing this. I can't believe how easy this is. That is, we know intellectually, people know intellectually this is not easy. And when you start to believe it's easy, it's really emblematic of, well, we are in a mania of grandest proportions.
All right. And Mike, I'm sure that, you're talking to other people in your profession. And I know that, it's hard to find guys like you. There's a lot of sort of standard, buy and hold stocks for the long haul, financial advisors out there. Are you seeing sort of a similar, irrational thinking on their end, from the brokers that are advising these people as well?
Yeah, I mean, I think it's pretty rare to have a contrarian viewpoint, particularly this late and deep in a bubble. Sometimes I wonder if that's, something to brag about, that we're different and contrarian, because it certainly isn't the easy path. We do know a few good people in the business, but they're, that basically that really care about the truth and that study it and that kind of do the hard thing and talk about it all the time. There's not a heck of a lot of them, though. I will tell you this, my personal experience, and I know that John and Justin have similar experiences over, let's say, these last few months since the February high. We've talked to many hundreds of people, and I can't think of a single example myself out of, probably at least a couple hundred people that I've talked to, and a lot of them simply just, not current clients, people just wanting to talk and get some advice and some, maybe an opinion on their exposure. Not a single time has one of them said they've talked to their advisor and had their advisor say, you might want to evaluate your risk, you might want to reduce stock, what about, gold and silver or other hard assets, you might want to think about that. So if the people that we're talking to are really starving for that kind of message, And it feels like we're up against the whole world a lot of times, but we do this because we really believe it. We think that we're in one of the most highly overvalued times in all of history as relates to the U.S. stock market and most other markets in the world. We still think that this is a bounce from the February 19th high, whose job is to get it feeling like we're going back to normal. You know, the fear of missing out has been pretty incredible. The other advisors that say stay the course, don't sell, of course, you know, they feel like they've done the right thing for people, but so far, I guess maybe it has been because the markets are higher. But yeah, we feel like the lone wolves out there a lot of times, but we're going to keep saying this. We think that the market, after this 82% retracement in the S&P, is extremely risky. If we get another wave down, which who knows could have happened today, it could get pretty fast and ugly. And so, yeah, we're going to keep saying the same thing. Reduce equity exposure, get down to 30% or less, which will give you some good ability to respond to future shocks if we have lower prices. So I know that's a long answer, but short answer is, yeah, we're one of the few out there saying this.
All right. And you talked about, wrestling with people who are dealing with FOMO, which stands for fear of missing out. And that's definitely one of the big drivers in the late stage of a bubble where things are blowing off to the ups. You get those blow off tops where people see things just going up day after day after day, like that guy was talking about in the video that we just showed, 10, 15, 20% increases day after day. You begin to feel like, an idiot for staying out of the market. And there's a lot of emotional pressure to get in. I think you guys mentioned this briefly, but you guys have been having to counsel people, right? I mean, even peak prosperity type people who understand all the macro issues and risks that we talk about at peak prosperity. It's sometimes even hard for those people to remain steady in the face of that type of, mania. Is that correct, guys? I see you nodding your heads.
Yeah, it absolutely is. And here's where, we're human too. We're talking about a human response here, right? A psychological, emotional response that we humans are programmed to have. And that's where data really helps us as individuals, as investment advisors and managers, really can kind of ground ourselves and keep our emotions in check. As miraculous as the rebound over the last couple months has been, which it's been historic, especially when you consider the economic backdrop. It's not at all dissimilar to prior episodes at major tops. So, for example, the most recent big episode that people remember is the Great Recession, the housing bubble bust in 08-09. So markets peaked in October of 2007. By May of 2008, even though the peak to trough decline ultimately was over 60% in the S&P, by May of 08, the market was within 9% of its October highs. So we almost got back to even, not dissimilar to this recent rebound brought us a little less than 5% from the February 19th high. And no victory lapping here. Who knows what tomorrow holds? We certainly could see a rebound, but the point is this rebound is not at all inconsistent with prior bubble highs or first sucker rallies in a bear market paradigm shift. Same thing with 2000 tech bubble. In March of 2000, the market peaked, and by May of 01, it was within 14%, which is pretty small, pullback of its all-time highs. Of course, it went on to lose over 50%. The tech-heavy NASDAQ lost over 80%. These are very, similar kind of sucker rallies in the early stages of a bear market. But to your point, Adam, yeah, we have been doing a lot of counseling of folks. It's such a seductive, story to think that the Fed can levitate things just because they can, right? When there's not when you actually think through, so to say, the Fed's going to pump money in and it's going to go into the stock market, right? As a reason for the stock market to go up. There's no such thing as money going into the stock market, because for every dollar that goes into buying stocks, someone is selling those stocks. So there's not like this massive wave of Fed liquidity that is just quote unquote new money flooding the stock market. All it is creating a psychological game of who wants to buy the stocks and who wants to sell them. And this liquidity is just creating a psychological fervor to go into the stock market. But for every buyer of stocks, there's a seller, right? So it's not like this net new money going to the stock market. So this whole idea that the Fed's printing money and it's going into the stock market conjures up this big, wave of new money. It's couldn't be further from the truth. So it's a psychological belief that people want to buy into because it's easy to try and rationalize the temptation to want to jump in these very dangerous markets.
All right, and I'm glad that you were talking about the Fed there because I want to connect this conversation to last week's conversation that we had with Wolf Richter. We had brought Wolf on because Wolf, great analyst on many topics, but certainly in following the Fed and its liquidity programs. And one of the things that Wolf mentioned was, most folks didn't realize that the Fed had already sort of shot the majority of its ammunition from this latest rescue effort. The Fed said, "Look, we're going to put over $2 trillion into the economy," and the vast majority of that was done in April. So if you look at the liquidity injections of the Fed over the month of May, they actually were a very small fraction of what was released in April. I mean, I think like less than 10%, right? And Wolf was saying, so one, you got to realize it looks like the Fed has kind of taken its foot off the accelerator a bit, regardless of what it's saying. And then secondly, he said, but what it's putting out is still pretty meaningful. I think, at the height in April, it was doing like 500 billion a week. And then he said that had reduced down to about 65 billion per week over the past couple of weeks. Okay, so yesterday, Jerome Powell appeared before the country and gave his latest update and outlook. And it was very interesting because I want to play a clip here in just a second, but he said some things that, I think in many ways are what the market wanted to hear, basically saying, look, I got your back, whatever it takes. I'm going to make sure that, the markets have the liquidity they need and that companies aren't going to go bankrupt for lack of access to credit markets and whatnot. But he did say that the Fed was going to be issuing at $80 billion a month going forward. And that's substantially less than just the 65 billion a week that we've been doing. And of course, that was substantially less than the 500 billion a week from back in April. So, there is sort of this interesting thing to keep in mind that, if you think it's all about liquidity, the liquidity is definitely trickling down. And then there's another thought too, which is, sometimes the Fed, it'll say one thing, I got your back, I'll do whatever it takes. But the Fed is never going to say, hey folks, I'm actually going to start taking the punch bowl away, right? They're going to be doing that kind of in the background. And I think that may be what's going on here, or at least we may be at greater risk of that going on here. And I want to talk about what's happened in the markets in just a second. But beforehand, I do want to play this clip from Jerome Powell. Let me play it right now.
We were to hold back, because we would never do this, but the idea that just the concept that we would hold back because we think asset prices are too high. Others may not think so, but we just decided that that's the case. What would happen to those people? What would happen to the people that we're actually legally supposed to be serving? We're supposed to be pursuing maximum employment and stable prices, and that's what we're pursuing. We're also—
All right, so what was interesting about that clip was basically Powell was saying, look, I don't care if I'm blowing an asset bubble or not. My job is to keep companies alive so that they can keep employing people, which honestly I think is disingenuous in a lot of ways. But it's if you take it on face value, it is a little bit concerning. Where he basically says, asset bubbles be damned. We're going to shove as much money into this market as we feel needs to go in there. And he spent a lot of time in other parts of his press conference talking about how he just absolutely doesn't think the Fed is contributing to inequality in the world. And of course, by definition, inflating asset bubbles is contributing tremendously to inequality. You're picking literal winners and losers, both in the economy, but also socially. The top 1% owns 50% of all stock market wealth. Right. So when you think of the huge amount of market wealth that's been created over the past 2 months with the rescue efforts, half of that's gone in the pockets of just 1% of American households. Right. So we've talked a lot about inequality and whatnot. So I won't bang that saw more here. But the key thing that I want to mention is that even though Powell basically said, hey, America, I'm going to be here to get your back, buddy. whether it was the downshift to 80 billion a month or whatever it was, the markets had a violently negative reaction today. So looking across the major indices, it looks like indices were down anywhere from I think it's like 5.5% or so with the S&P to down over 7% in the Russell. Those are big down days, but in the face of the sort of nonstop, endless run up of day of gain after day of gain after day of gain, that's a very rude awakening for a lot of the brand new investors that I think have been coming into the markets, maybe throwing money in with greater abandon than they realized, especially those Robinhood guys who are buying call options. Today was a pretty horrible day for them. So my question for you guys here now is, looking at what's happened in the markets, one thing we talked about last week, Mike, I think we saw evidence of one, but clear evidence today of an island reversal, and I'm showing a chart of that right now. So we're looking at the NASDAQ here, a classic island reversal there. Maybe you guys can chime in now. Last week we said, hey, we really hope the market begins to give us something a little bit more interesting to react to. I think today it finally delivered. So guys, what do you take away from today's action, and especially given the island reversal and Powell's comments yesterday? I know it's very early, but what's the potential for what's happened today to signify a reversal of direction for the markets? John, why don't we start with you?
Yeah, well, I guess the first thing is to not lose context. We had a big down day today, but it's still in the context of a remarkably improbable rebound over the last couple of months. So by no means should today's downdraft be taken by anybody that feels like they were on, close to the exit and waiting for their evidence to get more conservative. By no means should today's down action be interpreted as, oh, I missed my chance. Absolutely, it's timely to scale back risk. Oftentimes, it's these days that lead to follow through in the prevailing direction downward. So consider it another data point to take action to get more conservative. We do think there's tremendous downside ahead. And these are the kinds of seminal days that oftentimes lead to that follow through, which ultimately yield opportunities for us to start to become proactive investors again, not just sitting patiently waiting for things to abate. There's a lot of hot air below us, but with each a bit of deflation there of asset prices, it presents that much greater an opportunity to start to become selectively invested in markets.
All right, and I'm glad you started with telling folks that, hey, if you were thinking of taking your chips off the table and still want to, it's not too late to do that. And again, this is one day; it doesn't make a trend. This could be a hiccup on the continued bull run of the markets. Personally, I think the probability of that is now a lot lower than it maybe was last week. But I do want to bring up a slide that Mike mentioned earlier. This is the psychology. The pathway that sort of common asset bubbles follow. Mike talked about, when you see the drop from the very top, it goes down a bit, and then there's a recovery that tries to convince everybody that things are returning to normal. And Mike, you mentioned that earlier. And the job of that rally there is to try to suck everybody back into the mania, right? And that's why you get to the points like we were at just up until yesterday, where that fear of missing out comes in, that fear of like, this is my last chance to get on the gravy train. It suckers in the last fool, and then everything collapses. And the thing I just want to urge here is that we've been talking about the importance of positioning yourself defensively, because when markets reverse, they tend to reverse faster and more furiously than they rose. And so you can get caught flat-footed. And if you delay for too long, you can lose an uncomfortably large part of your portfolio before you actually get your actions implemented. So, we're going to continue, I think, recommending to folks, look, if you're not fully bought into the current mania, it is probably at this point maybe getting very late in the game to get yourself defensively positioned. And I would definitely take today as a wake-up call. As John mentioned, it's certainly not too late. But if you feel you were in danger of becoming complacent, hopefully today shook you out of that complacency. So Mike, building on what John said, how are you looking at what's going on here? If you wouldn't mind, you defined it last week. If you could just redefine really quickly for folks what an island reversal is and why that's important. And then anything else that you'd like to add in terms of just, what folks should be thinking about in this current investing environment.
Yeah, so this is a really prominent example of an island reversal. I'm looking at a chart of the S&P right now, but you mentioned it before in the NASDAQ. Essentially, when you have an island reversal, you have a market that gaps. And a gap means that at the beginning of trading in the morning, the price goes in one direction outside of the previous day's direction. So, let's say that we close at 100 on an index today, and then tomorrow morning we open at 110. Well, that's a price gap of 10 points, and that just shows up as open air on a chart. And so in this case, the S&P about 5 days ago, it broke out, it gapped up, and it stayed there for 4 days. There's four bars where it consolidated right around 3,200 or so. And that created, we had a gap from about 3,100 to almost 3,200. I guess that was last Friday that gap was created. We traded there throughout yesterday's close, so four days. And then today we gapped down, and we left an island of those 4 bars up there all by themselves. It's pretty prominent when you look at a chart, and it's pretty significant. I mean, nothing's absolutely guaranteed. Technical signals are to be used as guideposts, not as absolutes. But in this case, in the context of the crazy raging bullishness and euphoria that we've been watching, in this very historic retracement, again, this is one of the largest retracements ever in the type of what we think is a corrective or kickoff to a bear market. It's an 82% correction. You have to go back to 1937 to see something like that, 80+% correction. Most of them around 50 or 60%. But this one, with the Friday jobs report, sucked a lot of people in, and that gap up brought a lot of people in. A lot of shorts had to close out their positions. They were forced to. We traded sideways for 4 days, and then all of a sudden today, boom, we gapped down, creating a stranded island up there in the 3,200 range. Again, not a guaranteed indicator, but a very ominous one in the context of the deep retracement, the euphoria that we've seen, the historically low put-call ratios. Look at the 5 and 10-day put-call ratios. They're off the charts. The number of call options being open, off the charts. Valuations still near the highest in history, probably the highest in history if you take declining earnings into context. This is, as John said, this is something that should be heeded. Don't feel like it's too late. I'm looking at the chart. Even with today's big drop, we're only back to where we were 2 weeks ago. That's how vertical this market went the last couple of weeks. So if this is a kickoff to that next wave down that you showed on that chart, the majority of the damage in a bear market is done in that kind of third wave down. It happens quickly. Upwards of 70 or 80% can happen in that time frame. In 1937, it took 3 or 4 months to, essentially drop nearly 50% from the high. I was looking at that chart earlier. So don't panic, but do take it seriously if you're overexposed, and do thoughtfully think about reducing exposure.
All right. I want to reiterate too that, this Peak Prosperity's YouTube channel, I'm one of the co-founders of Peak Prosperity. New Harbor is the endorsed financial advisor for Peak Prosperity. You're getting our guys' perspective. But after years and years of being lonely voices out in the world who were, warning people about valuations, the chorus is now getting pretty loud, and it's got a lot of names that folks, recognize that are, members of the investing establishment, guys like Muhammad El-Arian and whatnot. I mean, just investors who manage, billions in these massive funds are expressing the same concerns that we have at this point in time. So, again, could the stock market go higher from here? Sure, it very well may. We're going to be talking and pointing out about how that's going to be incredibly departed from the underlying fundamentals and historic valuations and whatnot. But my point is that this is not a fringe view that we're giving right now, that markets are dangerously overvalued and at substantial risk, I would say uncomfortable risk, if you're along this market, of a substantial correction here. So that's just where they are today. Now, I do want to focus, I'm going to bring up a couple of headlines here. I do want to focus very briefly on the coronavirus, which, if you are a watcher of our YouTube channel, you know that my partner, Chris Martenson, publishes regular videos on the coronavirus, has been doing so for the past 140 days, I believe, since late January. And I'm actually dressed up like this today because I was just on a Zoom presentation with Chris talking about the coronavirus. And, I think right now, in most people's minds, there's this sense of, okay, we've gotten through the worst of it. State lockdowns are easing. We can kind of begin to put it behind us. I'm not entirely sure it's going to be that easy. And Chris doesn't either. And seeing the headlines here, not only is the U.S. crossed the 2 million mark in terms of coronavirus cases, but I think more worryingly is we're seeing a number of states that are seeing an increase now in coronavirus cases. And that's because of the lifting lockdowns, people going out of their houses, beginning to congregate more publicly. And I'm sure that the protests that have been happening around the country for the past couple of weeks, bringing tens of thousands of people together, in packed circumstances, haven't helped either, right? So the flag I want to wave here is the whole thing that caused the initial 30x% drop of the markets back in March, was the coronavirus. And we may not be through the woods as much as we think. I just saw a stat from today's video that we're about to launch on the coronavirus that over 20 states are seeing an increase. So it's not just one or two. It's getting close to almost half of all U.S. states are now seeing coronavirus back on the rise. So my question to you guys is, and I know I'm asking you to speculate here, but personally, I think if we do see a resurgence in coronavirus across the country, and that maybe we're going to have to be engaged in this hammer and dance, which is something we've been talking about in the coronavirus videos, but where you bring in the hammer, you lock down the state, you then begin to ease it until cases spike again, and then you've got to clamp back down again. If we enter a period like that, I just don't see any way, shape, or form how that would be positive for the economy or the market. So I think that would be another shoe dropping here. John, I see you shaking your head there.
Yeah. Well, so very opportune moment to I think remind folks that markets were in very dangerous shape even before coronavirus came on the scene. Tremendously overvalued. The Fed was pumping billions in overnight repo liquidity last fall before there were any kind of visible signs. We had a sick financial market choking on liquidity and easy money, and a lot of nascent problems starting to emerge. So in a sense, markets were bound to kind of run into some difficult spots, just due to any number of catalysts. It so happens that coronavirus was the catalyst that came on the scene, a very dastardly one at that. But let's not mistake, this recent malaise and market volatility on the coronavirus itself. It's really that's the catalyst that brought to light problems that were destined to surface. But yes, to the point that it is a catalyst that is proximate to the issues. Of course, I think it's elementary that any kind of delays or difficulties returning back to normal, which I think we're not going to, there's so much, we talk to business owners and other, so much has been discovered, I suppose, in a way, as a result of what this remote environment distancing has, so for example, many businesses are realizing they can get by with less, maybe fewer staff members, maybe they don't need the office buildings that they were paying a lot of rent for. These are kind of deflationary things, kind of contraction in facilities, contraction in workforce, that even if, the virus kind of is kept in check, and, I think there's going to be lasting paradigm shifts here that have a contractionary kind of element to them that will persist for quite a while. And I think the Fed knows this. they were talking about yesterday, even despite their, promise to do every bit of magic they have in their toolkit. I think they were truthful in the sense that they see this being a long, drawn out thing that, and many people, unfortunately, that have been displaced from work may never find meaningful or similar work ever again. Obviously, for aging folks that are towards the end of their careers. So this is going to be a profound thing that will be with us for quite some time. I'm pretty sure of that.
All right. So wrapping up here, look, we do these weekly videos to keep as many people as we can informed about, what's going on in the markets in any given week, but it's done in the larger context of all the unsustainable risks that we at Peak Prosperity see in today's economy and in the markets. And I think it's safe to say that we've never seen a disconnect between the two, the reality on the ground in the economy and where the markets are, than we have over the past 2 months. And I say that having lived through the dot-com bust and to a lesser extent, the run-up leading to the 2008 Great Financial Crisis. So what I want to underscore here is this is a very, very treacherous time for people who have wealth and want to preserve that wealth. And I think if you are using the stock market as a way to grow your wealth, if you just have sort of standard long positions, I think you really have to ask yourself, okay, am I prepared for if reality and market prices catch up to one another by market prices coming down versus the fundamentals somehow magically rising to meet the market prices? And so where I'm going with this is one of the messages that we reinforce at the end of all these videos is we think that if you're going to keep your money in the markets, you need to talk to a professional financial advisor who's seasoned enough to have been through a couple of market busts, who understands the risks that are in play. And we have worked for a decade with the guys here at New Harbor Financial. I don't need to tell you how they think because you can get that from listening to these videos. If you have a good financial advisor on your own already who does this for you, that's fantastic. Stick with them. Right? Not advising you change horses there at all. But if you're watching this and you don't, and you have trouble finding one, I think both the time urgency has really gotten, I think, compressed here. But I also think just sort of the magnitude of the correction that could potentially be coming. Mike talked about how the second down legs of bear market corrections tend to be the really big and bad ones that can be as large as like 80%. So, look at your portfolio and ask yourself, what would I do if that dropped 80%, if the market dropped 80% over the next month or two? So at the end of this video, as we always do, we'll put up the link for how you can schedule a free consultation with the guys at New Harbor if you want to. There's no cost, no strings attached, no pressure to work with them. We'll also, guys, as we always do, as you're talking throughout this video, we'll put up the link underneath your faces as well so that folks can reach out. But my advice here is, if you haven't yet, now is the time to talk to a seasoned professional advisor who gets this stuff to make sure that whatever happens in the future, you feel like you put the right strategy in place. Because as we've been talking about many times in this video here, we think the probability of increased volatility is high going forward. And we're seeing a lot of indicators that we would expect to see if what's happened over the past 2 months has been a classic bear market rally, which, as we said, its goal is to suck as many people into it as possible and then pull the rug out from under them and drop prices, oftentimes too fast for them to react to and too far for them to recover from over any comfortable timeline. So guys, with that closing perspective from me, I know you guys, the phone's ringing all the time for you guys, but I know that it's probably been ringing a lot today, given what's been going on in the markets. Any closing comments or perspective for folks that have watched this video, maybe a bit more concerned than they were when they started about where markets are and trying to juggle what they should be doing with their wealth?
I'd add, Adam, is the hardest part of making changes is the actual decision part. The mechanics couldn't be simpler, right? It's a click of a mouse, right? But it really speaks to the decision part, which is a cognitive, emotional, psychological part. And that's where having a conversation with an objective person, advisor, can be very helpful to untangle one's own, inertia, mental inertia about making a decision. Look, I can speak for us. Nothing about what we do is salesy or meant to kind of entice someone to make a decision that they're not ready. We simply talk through things from a factual, objective standpoint using data. So it's it can be a safe space to explore, kind of an inertia when it comes to decision making about what to do. And that's a catch-all thing. What should I do? That we spend a lot of time talking to our clients and prospective clients about.
All right, great. Well, thanks, guys. I'm going to close here. I need to go get back onto my second Zoom presentation on coronavirus. So I'm going to be joining Chris on that in just a couple of minutes. I know you guys have a lot of customer inquiries and meetings to head back to. So as usual, thank you so much for taking the time out of your very busy weeks, especially on such a busy day, to share your insights and perspective on what's going on here. I feel like I kind of put the juju out there in the universe last week by saying I hope the market gives us something more interesting to react to. I apologize for any of those of you that were the folks that maybe were buying some of those call options and are feeling a bit bruised and bloodied after a day like today. But guys, I do hope that as we head into next week and we meet up here in a week, that we at least see enough evidence during the next 7 days that we get a better sense of where things are going here. The melt up that we've been in is good for nobody, right? Mm-hmm. It's not good for price discovery. It's not good for helping investors make good decisions. It tends to sucker a lot of inexperienced people, and oftentimes the people who can afford to lose the money the least. And again, our whole intent here is to try to help as many people as possible preserve as much wealth as possible. And that's sort of the antithesis of a late stage asset bubble. So with that, I will thank you guys for joining. Wish you well on watching these markets over the next couple of days, and look forward to hear what you guys have to elucidate when we get back together in a week. So thanks so much, John, Mike. See you guys
next week. Good chat with you again, Adam. Thanks.
Thanks, Adam. We're always happy to do this every week, and grateful that you're putting these together. So thanks.
Well, they're a lot of fun, guys. Thanks so much, and take care. If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you'll work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.